Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of FATCA India, offshore reporting and U.S. tax for foreign nationals who are also considered U.S. persons. So, when it comes to FATCA, FATCA is the Foreign Account Tax Compliance Act. It was entered into with India, I believe, in 2015. Um, it, for U.S. persons, or individuals, I should say, they start filing back in 2012 on their 2011 tax return on a Form 8938. So basically, for individuals, the Form 8938 is what's required. It's also estates and trusts and things like that. But for focus of today's presentation, we're just going to focus on individuals. Who is a U.S. person for FATCA? Well, that generally will be three categories. It'll either be a U.S. citizen by birth or naturalization, a legal permanent resident or a green card holder, or a visa holder or foreign national who meets the substantial presence test. You're here on even B1, B2 tourist visa, EB5 investment, H1B, L1, E2, E3, O1. If you're on any of these types of visas and you meet substantial presence, then you're considered a U.S. person as well. Substantial presence, it's more than 182 days in over a 3-year period using a 1-to-1, 3-to-1, 6-to-1 ratio. There are some exceptions, like if you're here on F1 for the first 5 years, but beyond the scope of today's presentation. Before we get to FATCA, let's just focus on income. So if you are a U.S. person, you're a green card holder citizen, you're here in H-1B, you're subject to worldwide income. So if you're living in India, or even if you're not living in India, if you're earning money there, whether you're working there, maybe you have an NRO, NRE account, a PPF, or an EPF, the rules are different for those two, though. A DMAT, life insurance, foreign mutual funds, you have to report that income. PPF may grow tax-free in India. The accrued money is still taxable. And EPF is still employment. It's normally not until you start taking distributions. All of that money is taxable in the U.S. And if it's based on foreign financial assets, it may be reported on your FATCA Form 8938. When you have earned income, you may qualify for the foreign earned income exclusion, in which you can exclude up to $105,000 of your income. That varies; it goes up with inflation each year, cost of living adjustments. And there's also a housing exclusion, which gets complicated, but generally, if it's under 15,000, no. Between 15 and 30,000, yes. Over 30, no. You also get what's called a foreign tax credit. Now, depending on how much income you've earned overseas versus the U.S. and the different categories or buckets, as people like to call it, you may be able to exclude large portions of your tax because you've already paid that tax. So I guess technically you're not excluding it. You're getting a foreign tax credit for taxes you've already paid overseas. It's not always a 1-to-1 ratio. It's like a hybrid calculation based on the different types and how much income you have earned in the U.S. versus overseas, with the idea that you can't use the foreign income to reduce U.S. sourced income tax liability. So FATCA India. When it comes to FATCA India reporting, the thresholds are all the same. Depending on what country, doesn't really matter. What it's based on is the individual. Are they filing married, filing joint, married, filing separate, or are they single? Do they live in the U.S. or do they live abroad? So when it comes to the Foreign Account Tax Compliance Act, you have to report specified foreign financial assets. All different types of assets are included in there, certain investment and bank accounts, unless excluded, ownership or interest in various corporations, entities, partnerships, unless you're filing 5471, let's say, or an 8865 on that same asset. Sometimes cryptocurrency, there's no specific ruling on that yet. Most experienced practitioners would say yes, you would file it for 8938 since it's an asset, but not set in stone. The requirements go like this, the threshold requirements. If you're single or married filing separate and you're a U.S. resident, it's $50,000 in annual aggregate total on the last day of the year. If it's under 50 on the last day of the year, more than 75,000, on any other day of the year, you would still file the Form 8938. Conversely, if you live overseas, you're a foreign resident and you're married filing joint, those numbers shift to 400,000 last day of the year. If under 400, more than 600,000 on any other day of the year, you'd have to file it as well. Now, beyond FATCA, there's other reporting required as well. Most people will have an FBAR, which is Foreign Bank and Financial Account Reporting, FinCEN Form 114, a much lower threshold, $10,000 annual aggregate total, whether you're filing single, joint, separate, or you're a U.S. or foreign resident. Form 3520 for foreign gifts, Form 3520A is an Apple for foreign trusts, Form 5471 for foreign corporations, Form 8865 for foreign partnerships, and you can go on forever. There's a ton of forms. But normally when someone has a FATCA reporting, they generally may overlap with other reporting as well. So what do you do if you haven't been compliant? Well, if you haven't been compliant, you should get into compliance because most of those institutions do report, and at some point, once you have the knowledge, if you continue reporting, you can get yourself into a bind in the future. There's various different programs. There's the traditional voluntary disclosure program, which is basically for individuals, corporations, businesses, trust estates who cannot certify under penalty of perjury that they are non-willful. I apologize for the double negative, but that's the way that the verbiage is written. So if you can't certify that you're non-willful, you'd go the traditional voluntary disclosure route. They got rid of OVDP, but they expanded traditional voluntary disclosure. Despite what some inexperienced practitioners may tell you, it's still a great program for some people. For example, if you have low FBAR reporting, low assets, it's mainly informational reporting and not a significant amount of income, it could be a great program. We have an entirely separate presentation for that to assist you with that. Common are the streamlined programs, streamlined domestic offshore procedures, streamlined foreign offshore procedures. To qualify for either program or for both programs, you have to be non-willful. It permeates through both. Even though there's different requirements, streamlined domestic generally requires that you had filed timely tax returns. Timely is up for debate based on our own discussions with IRS agents throughout the years. Streamlined foreign is a great program because you can file original tax returns and there's no penalty. All the Title 26 miscellaneous offshore penalties completely waived. There's alternatives to the streamlined program. There's delinquent international information return submission procedures. There's delinquent FBAR submission procedures, and there's always reasonable cause. My name is Sean Golding. That was an introduction to FATCA India and offshore tax and reporting requirements. We have our main website, goldinglawyers.com. We've got a ton of free information on there. We have our international tax law blog, which we try to update daily, if not weekly. Tax season, it slows down a little bit, as you could imagine. We also have a sister website, IRSstreamlinedprocedures.com, to assist you navigate the maze of the streamlined procedures. Thank you for your time. I know it's a lot. Enjoy the rest of your day.